We are on class number 23. So there's 42 classes in all, so that means 19 classes left. Wow. Of course, starting spring break, so I hope everybody has a wonderful spring break and is very careful. Today we're going to finish talking about chapter 7, and before we do that, I'll just remind you of what's coming up. We will have tonight, we have two things due tonight. One is this before presentation self-assessment. You don't have to know anything other than how you feel about presentations to answer this, so just go do this and it's 10 points. Then we have the chapter 7 quiz that's due tonight. So just a normal quiz. Exam 2 will be the Wednesday we come back from spring break. So during our class time, Wednesday, I believe that's March 22nd, not 23rd. Let me edit that. Okay, that's fixed. All right, so keep in mind that Monday, of course, will be a review, and you have a lot of study materials you can use. And again, out in the study guide, the actual questions are out there for the essay questions. So I expect decent answers. You have the questions in advance. There's no reason to not have a complete full answer for these short essay questions. You have plenty of time to look up the answers, have them ready to go. So I expect a decent answer. All right, so that's about it. Just remember that tonight, survey and quiz due. On to finishing chapter 7. So obviously when we audit, we are employing the audit risk model to help us decide what to test, when to test, how to test it. We're interested in risk and reducing the risk of getting the audit wrong. So that means we have to understand the inherent risks. We have to test the control risk. And once we understand inherent risk and control risk, we understand risk of material misstatement. So there you go. We are ready to pick out our substantive tests and reduce our detection risk by using more or better substantive tests. We talked about the inherent risks in this revenue and collection cycle, mainly auditing, of course, revenue and accounts receivable and the various little smaller accounts that go with them, sales returns, allowances, allowance for bad debt expense. Most of those are not particularly material, but obviously a material mistake can enter a lot of different places. So we got to pay attention to all the accounts. Revenue recognition, the big inherent risk in this cycle. We talked about revenue recognition issues. We talked about obviously understanding the controls. And we have decided that we're going to test controls, right? So if we understand the control activities, I think this is about where we left off. And we know what controls should be in place, right? So for example, revenue, the biggest problem is occurrence, right? That's the main thing, right? So management may overstate sales. That's the big problem. So how do we prevent that? Well, we don't really book any sales until there's an actual invoice supported with a customer order, bill of lading, right? So we can prove that we actually sold something and shipped it. So as auditors, we're interested in testing that control. So what do? We vouch, right? Vouch for occurrence, trace for completeness, All right, so basically testing revenue, we're testing occurrence. Are those real sales, right? Which means we vouch. And of course, we do test for completeness. It is not as big a risk, but some sales could be left out, and then that would misstate the account. So we trace. So what could happen? Cutoff sales could be in the wrong period, right? So again, we're going to trace and make sure those that we're using the date from the shipping documents. So all just very normal procedures. Accounts receivable. Of course, the big problem with accounts receivable is if you're up here doing this, right, making fake sales, it's entirely possible that you'd have fake receivables to go with that, right? And again, it's possible not all receivables get in, but completeness is not the main risk we're worried about. So what do we do? Well, vouch, right? So we're going to basically test the documents, right? So when there's a sale and when there's account receivable, there's these documents we learned about way back here, right? We've got some kind of a customer purchase order coming in. That purchase order probably has an authorization, right? There's shipping documents. Okay, let's ship that. Well, now we've shipped it, let's invoice it, right? Then we collect the cash, right? So there's documents we can check on, right? So when we're checking documents, it's important to understand there's two directions you can go in, right? And your test has to be relevant to the assertion you're testing, right? That's what relevance means. We're talking about testing assertions. We're testing either, in this case, in this example, we're testing occurrence or completeness, right? Those are the two assertions. And as I've said, occurrence is definitely more important than completeness, but still you would test for completeness. So the main problem is there could be some fake revenue, right? Well, where would the fake revenue be? Well, it would be in the sales journal. They would have put it in there, right? But there would not be supporting documents. So you have to start at the journal. So what directionality of testing means, where do you start and which way do you go? So to test for occurrence, right, which is the main thing we want to test for, we're going to do something called vouching. Vouching just simply means you start at the general ledger or the journal, right, where the accounting entry is, and you go back to the supporting documents, right? And so what you're looking for is typically back to the invoice, back to the shipping document, back to the customer order, right? And you're going back. So you pull your sample from the sales invoice file or the sales journal or the revenue ledger, something like that, where it's like, this is the ending point. This is where that sales revenue ended up. And they're telling you this revenue in this file occurred. So you're testing it. Well, did it? How can I tell? I can go back to the original documents. Other direction, starting with the documents, right? And going to the ledger or journal, right? So testing for completeness, we call this tracing. So I start here and I say, hey, we shipped this. Did we recognize the revenue for this thing we shipped? So you have to start at the transaction document and go and make sure it got in the journal, the ledger, got into the document. So your directionality of testing is what makes your test relevant, right? If I'm testing for completeness, I can't start up here. This doesn't make sense to test for completeness here because by definition, everything that's there is there, right? I can't pull something from here and test for completeness because it's there, right? Just like I can't test for occurrence from down here because these occurred. I know they occurred, they're real. If I go that way, I'm testing for completeness. What other tests are there? Well, you will test for completeness. Like I said, the main thing for sales and accounts receivable is occurrence, right? We care about, did this really happen? Because they're assets, it's revenue. You tend to want to overstate it if you can. So that's the big test. But we do have to test for completeness. We'll test for accuracy. We'll test for cutoff. Is it in the right period? Classification. Is it actually a receivable or something else? Was it a return or something? So once we've tested these controls, right? Are these documents here? Are they doing the right thing with the documents? Now we're going to do what we call substantive tests, testing the actual financial statements, right? So those numbers, are those numbers the right numbers? So with revenue, the problem is typically occurrence, right? So they may overstate, right? There's the control of the documents. We test the documents, and then, right, we might compare balances to help detect overstatements, do some analytical procedures, right? Analytical procedures would never test a control because you're just testing comparing numbers. So we might do something like a ratio, right? Compare it to industry, compare it to what they estimated, compare it to their cost of goods sold, compare numbers, right? Compare these balances, right? The balance, the number on the income statement, the number on the balance sheet, compare it to some other numbers. Does it make sense in this context, right? And of course, look at sales returns, right? If there's a lot of sales returns, that could indicate those weren't real sales or somebody's stealing. So analytical procedures, then do tests of details. So substantive tests are those comparing numbers. Details are, I'm going to get the invoices. I'm going to get a sample of invoices and vouch them, right? Right, vouch them all the way through to the end. Or select a sample of returns after the year's over, right? To see if, oh, they ramped up a bunch of sales by doing a bunch of sales that they knew weren't real sales, right? That we talked about channel stuffing, and then they all got returned in the next year. So if they got returned in the next year and they actually kind of knew they were going to be returned, those weren't sales, right? So you can select these samples and examine them after the fact. Possible problem with revenue is completeness. It's mostly unlikely that sales go unrecorded. Of course, the control activity are all the documents. Of course, we can scan the documents. So to make sure all the sales got in, what can we do from an analytical perspective? Well, we can compare sales to this year and last year, make sure they all got in. What did they estimate sales would be? Make sure they all got in. What are our accounts receivable? Are they higher than sales? That wouldn't make sense. You know, there's analytical procedures you can do. And again, select a sample and trace. Remember, trace for completeness. So again, checking that out, and cutoff is just, did it get in the right period, basically? So what's the control activity? It's the date stuff was shipped. So to test the control, you can see if they're dating stuff on the date it was shipped. Again, analytical procedures to make sure stuff's in the right period. Oh, compare stuff around month end from this year to last year. Compare, again, accounts receivable to the shipping, something like that. And again, make sure that you can trace those documents and say, you know, is that correct? Did it get in the right period? Basically, just comparing the date it shipped to the date it got posted. And what else is making sure for cutoffs? Management should be evaluating and looking at reports. Make sure management is doing that. Check out contracts. Next, account for substantive procedures, accounts receivable. Again, the main risk is existence. If there's fake sales, there's probably going to be fake receivables. So they should have the documents that prove they're real. You can test it, right? Vouch, right? What can you do substantively? Substantive procedures. First, analyticals, again, comparing numbers. This year's balance to last year's balance. Are they similar, or did they increase in the expected amount? Does it compare similarly to sales? How much are write-offs? You can compare sales and cost of goods sold and all that. Things that move in the same amount as accounts receivable, you could compare them. What's a test of detail? The main test of detail for accounts receivable is what we call confirmations. All right, the main test of detail, right? So it's not an analytical procedure. You're really testing some detail. You're looking at a document, you're doing something specific. It's confirmations. Confirmations. So a confirmation means for those accounts receivable, you actually contact the customer who owes that and check it out. Do you really have this balance? Valuation. So the problem with receivables is they don't always get paid, right? So there could be some kind of discounts for cash. There could be an allowance for doubtful accounts. So there should be some kind of management authorizing discounts. There should be some kind of management reviewing account past dues and writing them off. So how do you test that? Again, check for indication there were those approvals, right? Authorization. What's an analytical procedure? Well, write-offs should be compared with the estimate, right? So if there's going to be a bad debt expense, right? And it should track fairly closely with the estimate. If your estimate seems wrong, it's like, oh, we're running out of money in our allowance, increase it, right? So how are they doing their estimate? What is it? How is it tracking with what they're actually writing off, right? That would be an analytical procedure because just looking at comparing two numbers. Substantive test of details is go get the age trial balance, compare it to the right. So you're actually comparing document to document. See how they calculated the allowance, get their calculation, redo it, right? So specific tests, test receivables, age trial balance, confirm balance, perform analytical procedures, test cutoff, right? Analytical procedures we can use. So I've kind of already discussed this, but you can compare with previous periods. You can compare with industry. Compare us about bad debts as a percentage of sale, percentage of gross receivable, receivables, days sales and receivable, account receivable turnover. How fast is it getting paid? If they're getting paid really slowly, maybe those were fake receivables. So you could investigate a little more. The main account receivable substantive test of details is confirmations. You're verifying existence. So you really are supposed to do some confirmation. So basically you pull a sample of the account receivables from the subledger, right? So you have 50 account receivable of customers, and you're going to actually contact those 50 customers and say, hey, confirm this account receivable balance. My client says you owe them this much money. Is that true? Right? So depending on how much confirmation you do, is going to depend on your experience with this client, who you're getting confirmations from. Are they reliable? Right? So banks are pretty reliable. It could be there's some random customers of your client that aren't. What kind of information is being confirmed? You can confirm entire balances or just transactions. And there's different kinds of confirmations. So let's talk a little bit about this. There's three. So when you send a confirmation, there's three sorts of confirmation: positive, negative, and blank. So positive means you've requested that customer, your client, you're basically you're emailing or texting or writing a letter on paper or faxing. You're somehow contacting a customer of your client, and you're saying, my client says you owe them this much. Is this true? Please email me back or text me back or whatever to confirm, right? So you're actually requesting they contact you back. That's what a positive confirmation doesn't mean. They're replying positively, yes. It means you want them absolutely to return your email, your call, your letter, right? So you are getting a guarantee that they looked at your request, they thought about your request, and they responded to your request. That's a positive confirmation. You couldn't do it for a lot because obviously you wouldn't want to open that many letters or get that many faxes. And if you think there would be an error or something's going on. Negative confirmation is pretty easy. Negative confirmation means you've contacted your client's customer and you said, hey, my client says you owe them $100. If that's true, don't worry about it. Don't do anything. Only respond if that's wrong. So write us back and tell us what your actual balance is. So that's a negative confirmation. It means you know, you won't get anything back if everything's fine. So you it's a little riskier, right? Because you won't really know if they actually read your email or text or fax and just threw it away, or if they actually like, oh yes, this balance is fine, I'm not responding. Blank confirmations is, I guess, when you really feel there's a risk that the customer who receives your request is not going to pay attention to it, might not respond correctly, might just throw it in the trash or something. So say, tell us. So you're not telling them, hey, you're a customer of my client. My client says you owe them $500. Is that true? For positive confirmation, please respond yes or no. For negative confirmation, only respond if it's no. Blank confirmation is tell us how much you owe our client. So you're relying on that customer of your client to look at the confirmation, maybe look at their statement with your client, and then go, oh, this is how much I owe. So that's like the highest level of confirmation. Things to remember when you do confirmations. And again, this is pretty much required under audit standards. If you don't do confirmations, here's why you wouldn't do it. It's not material. So your client, audit client, doesn't have accounts receivable, right? Or has very few, just a few select customers that they've done business with for years. They let them pay later. So it's not material or very low risk of misstatement. You know, the assessed level of evidence shows that it's not a risk. So if it's not material, fine, we won't confirm. Or if it's not risky, it's like, well, every single client has been vetted. They've paid for years and there's just no risk. These are real, you know, I know for a fact these are good, so we're not going to send confirmations. Or it's like not worth it. The balances are tiny, and it's somebody like who doesn't really have, you know, it's maybe it's like McCoy's, and you have a whole bunch of guys who are sheetrockers, painters, carpenters, contractors of various sorts, and they are just always out in the field doing stuff. They just absolutely don't ever, we've mailed these things to these guys and they just don't do them back because they just aren't there. They don't, you know, not going to do it. It's not worth it. So there's that. If you have things that happen on confirmation, so when you mail out your confirmations, If you get something back that says non-deliverable, or that phone number doesn't exist when you try to call, or there's some problem, you need to investigate that, because those are probably fake accounts receivable. Responses to positive and blank are better than negative, right? Because you don't really know. If you send out negative confirmations and you don't get one back, you don't really know. Well, did I not get one back because it was accurate? Or did I not get one back because they just threw it in the trash or something? Recipients of accounts receivable might not report understatements, right? So if you're testing, a misstatement is a misstatement. So you want to know about understatements too. So if you send it out to one of your client's customers and you say, our client says you owe them $500 and they really owe $5,000, they're not going to say anything like, oh, maybe we can get a bill for $500, right? We're not going to come, oh, no, really, I owe you a whole lot more, right? So electronic responses, be careful. You have to make sure it's not coming from your client in disguise. So you can follow up. Sometimes it's a good idea when you send out positive or blanks, you can follow up. If you're not getting responses, does that mean those are fake customers? Follow up on anything that's weird. Here's an example of an account receivable age trial balance. So let me just show you this because you may want to get one of these. So a trial balance just means they've run a balance on a general ledger account, right? And so they've run a balance on this account receivables account. And here are your balances that are past due, right? So current or less than 30. So most accounts are current, less than 30 days past due. Some are 30 to 60 days past due. Some are 60 to 90 days past due. And here's two extremely large accounts that are more than 90 days past due. So at this point, I would want to know, like, why Malwart and, oh, well, that's the total. Okay, never mind. So why hasn't this account been written off, right? What's going on here? And why are they still giving them stuff? Here's something that's 30 days that's bigger than this. They give them another 4,000. So that's kind of weird. Anyway, you're just looking to see, like, well, these are kind of small, but this one is huge. It's, except for Bullseye, that's the biggest account there is. So this is a really big customer, by far bigger than anyone else, certainly material to accounts receivable, and 1 million of it's past due, and they still have 5.7 million on the books. So that could tell you, hey, they've got this account that's a bad account, 90 days past due. Maybe last quarter they put some fake sales from Malwart on there that never got paid, and now this quarter to do a bunch of fake sales, maybe they did it, I don't know, but you want to get these as receivable trial balance. And so I would definitely be looking at, who the heck is this? I would be checking their credit files. I would be checking, have they always been a customer of my client, or is this a new customer, right? Because a lot of times when they're doing fake sales, they make up a fake customer and it's like a brand new customer. For all these people who are paying on time, well, they are old customers, right? So that's a thing to look for. And just, this is an example of a confirmation letter, and you can see it's like, please examine the data and confirm or report any differences. So they want you to confirm. You're writing back. We want you, that's a positive. Confirm, either yes or no. Here's a negative, example of a negative. No reply is necessary if the information is correct. So that's a negative confirmation. And of course, guessing this is they don't have a blank confirmation example, but a blank would just look like this. But it would say you must reply, put the balance down here. All right, so how do you follow up? Well, just some ideas. If they say this was paid, that's fine. They probably just want to make sure, like, well, if you mailed it out as of December 31st, right? So balance sheet date is December 31st, right? So on December 31st, your client says, oh, these people owed money. This is their account, our list of accounts receivable on December 31st. Well, if it was paid on December 28th, yeah, you would want to look at that and see if they actually, maybe the check got in the mail, but your client didn't receive it till January 4th because it was holiday weekend or something. You would look that up, especially if it was material or very large customer. We are unable to confirm. That's the non-response. Do some alternative procedures. We return these, right? Well, then if they returned them, that should have reduced the account receivable. They received these on January 3. So again, holiday weekend, if they're saying it's an account receivable, that would have come on as that would have been a receivable as of the date of the shipment. So yeah, if they shipped it on December 30th, would it have not gotten there till the 3rd? Yeah, probably. That's very possible, but you should still, double check on that. Sales cutoff, again, in the right period. What could they do? They could hold the books open. So what do? You examine invoices and shipping documents. So again, the shipping document is going to be governing the date of the sale revenue and the account receivable. And you should go back and look for returns, right? Because one thing people do, we talked about this with the channel stuffing. It's the end of the quarter, we don't have enough sales. They channel stuff, they ship a bunch of stuff knowing it's going to come back. But hey, this is December 30th. It was shipped. It's a sale. If it comes back January 10th, oh, well, that's fine. All right, so you should examine that. But if they knew it was going to come back, then it's not really a sale. All right, so what else can you do? Right, so we've talked about a few procedures. Here's some other procedures. Cash collections. So, remember, we're auditing, let's say, December 31st balance sheet. Look at accounts receivable. It's $1 million. Well, we're not really auditing them till January, February. So probably a lot of them has been paid. So if I look at what actually got paid on those accounts, and I can go, yeah, that got paid on January 15th. So yes, it probably was a legit account receivable on December 31st. Examine shipping documents, examine invoices, inspect files, right? So if people are having a back and forth about a return or something, you would be able to see that. Inspect files for collectability, right? Bad debt expense, calculate those. Is it reasonable? Are they actually writing off as appropriate? One, if they are writing off fake sales, you would see too many write-offs. If they aren't writing them off, just letting them ride, you would see them there too. So make sure their write-offs are authorized. We're all going to skip all of that. So that's really pretty much it for chapter 7. Just reminding you that tonight, this little presentation self-assessment is due, and then quiz 7 is due. So those are tonight. So don't forget those. Don't forget that on the Wednesday when we come back from spring break, we will have an exam, but that Monday we come back will be the exam review. So have a great spring break. Please be careful and come back